Yeah, I
That little
see him.
microphone.
Yeah,
Okay.
he's unmuted. There he,
there,
there he goes.
there you go, buddy.
Yeah. So
All right.
I'm a brilliant money manager, but not with I'm not brilliant with Zoom sometimes.
Yeah, well, kindred spirit. So these guys dragged me kicking and screaming into the 21st century. And you should see me try and draw a trend line or anything on TradingView. People laugh, my hand shake. Anyway, Keith, last interview was very informative. I'm really looking forward to this one. If you can share your screen.
It's a green button that says share screen.
Yeah, sure. I don't have, I have a few charts we can jump around with, but I didn't have a specific presentation. We can go walk through a narrative, and then I can share a few charts with how we think things will move
or you know what? I could show the narrative's going to be dollar related, right?
Okay, sure.
Isn't it? Because I want to talk to you about your view on a recent piece that's been floating around Twitter, and I read it, and it has to do with the revaluing up of the US dollar. And I find it interesting that you went from a 0 probability of this happening to, I believe, if I read it correctly, that there's a decent probability that it could happen. So first of all, I want you to, just give us a little bit of the cliff notes of what you're trying to communicate to the trading public about the dollar here.
Sure, we'll take a run through it. So this piece, probability of revaluing the U.S. dollar, that was written by my colleague Keith Oland. So he's a really strong global strategist, and so he's the one that wrote that piece and came up with the narrative for it. So, but we all live and drink and eat the same food together. But so let's just run through the narrative. And the reason we wrote that piece, so we're global macro managers. We run long-only portfolios as well as we run a private fund as well. And all the themes and the strategies that we use, we have them structured, Dale, so that in our mind, we want to avoid markets where we believe the risk-return opportunity, it's just not in your favor. Think of the Hunger Games theme, they had that. But we want to avoid markets that we figured would have the opportunity of significant losses just overwhelmed your upside. So the bond market, for example, right now today you're looking at maybe a 2 to 3% upside, and your downside is a lot more than that.
Are you? Let me just interject. Are you a little surprised since our last interview how well the bond markets have behaved since that? Wild blow off at the end of March and then a cratering, and your thoughts again on the Fed coming into junk bond and corporate bond markets. Does it change the game? Have they nationalized the bond markets here, Keith?
Yeah, in some ways they have, Dale. So with bond markets, of course, you have to separate them between treasuries and everything else, or bonds, for example, as well. What they've done effectively, they removed the entire price discovery process. And, it's not for us to agree or disagree with it. It is what it is. And for anyone managing money, whether it's your own or if you're a fiduciary, it never pays to, dig your heels in and say it has to be this way. And instead, you have to look at it and say, hey, this is what the central banks are doing. Now let's manage around that. So what they've done, they've effectively tried to take risk out of debt markets, specifically out of credit markets. And, they've as well, they're providing support as well to the high yield market. So, pricing, the main ETFs people look at, of course, they've come right up. And they've also caused spreads to narrow as well. What we look at then, we have a vision how we expect all this to play out, Dale, and it plays in with the dollar as well, of course. So the first phase of the crisis or stress return in the markets, in our mind, was always going to be in credit markets. So not sovereign debt, it was going to be in high yield debt, investment grade credit. And once the crisis hit back in February, March, that's exactly what happened. And the main feature of those movements, what everyone should take away really, is that there's no liquidity in those markets. As soon as there's a sniff of risk or danger, everyone fled. I mean, we all know the stories now. Big books were trying to sell. There was no bid on corporate debt, nothing on high yield. Again, it's a completely different market than equity markets. Well, you'll usually always find a bid and offer in there.
Larger too.
Yeah, absolutely. And, it's like the gymnasium, it's a big dance, but there's only one exit at the end of the gym. That's exactly what the bond market is. So with the Fed doing what they did, I mean, if I was on the central bank committee, it would be our job to make sure credit is flowing through the system. And that's what they did. So it's understanding what they're going to do. So, but what happens next, though, it's real interesting. And we always say, like, if one event happens, then the probability of the next event happening increases significantly. Then if that event happens, then the probability of the next event increases significantly. So with our path or vision that we see happening, we wrote about that in our last global outlook as well, called the Law of Holes. And so the first event would have been credit markets. That has happened. What we expect to happen next would be to see risk start to emerge in the emerging market world, so both equity as well as credit and sovereign debt and currencies. And that is a market that the Fed has not locked down. They can't lock it down. The ECB can't touch it directly, nor can the Bank of Japan, and so forth. And that's where risk will move next. So in our strategies, we're no longer taking active exposures to credit markets in the developed world. Instead, we moved along to the emerging market world. But because risk first happened in credit.
What country in the emerging world do you like? And give me a symbol.
Well, it's more important to say which one do we dislike, Dale.
Okay, all right.
So
okay.
we're on the short side.
I see. Okay,
yeah.
You're on the
short. So
okay.
Another thing, so we expect contagion to occur. But I mean, if you look like specifically Turkey, they have a lot of challenges. So if you're an investor, and this talks with China as well, when you make an investment, you say, hey, is this a good value, good price? Do I get paid for doing it? But you need liquidity to get out. And that's, this ties with the whole dollar conversation. I think a lot of people miss in that. Say you want to park $500 million for one day. The treasury market is the only market that you can park that without affecting the price of the market on your way in and the way out. And it's deep enough to take that amount of capital going in. It can't happen in China, and that when we look at Turkey, like back to the conversation about emerging markets.
Oh, and the bonds couldn't do that either, huh? The 10-year bond in Germany.
Yeah,
couldn't handle that amount.
It can take some liquidity, absolutely,
but not as much.
Not enormous. So, for example, when you look at emerging markets, they all rely significantly on the dollar for capital flow as well as for trade. And when you look at Turkey, so we look at Turkey, do we want to short various parts of that market? Absolutely. Do we want to short their banks, for example? We would. However, by doing that, we would have to go inside the country. And then we're concerned if we are right, then all of a sudden that market gets locked down. There's capital controls put on. So it's an example where...
Because they've had a currency crisis for years. The lira has been getting decimated, right?
Yeah, absolutely. But all emerging market currencies have as well.
Yeah.
I mean, I know with the dollar, people look at the DXY, the DXY all the time, and they're saying, hey, it's broken down a little bit recently. But the US dollar, if you look at the Fed trade weighted index, the dollar is now at new highs.
There's the lira right there. If you want to look at it, Keith, there's a Turkish lira.
Yeah, absolutely. It's moving in line with all of them, like Brazil Real as well. Of course, it's there, South Africa. But the underlying theme, all these guys, they're starving for dollars. And I know there are a lot of dollar bears out there. And, it may surprise you, but we are bearish on the dollar as well. But it's longer term. And you become bearish in the dollar when you realize, again, what the path is, through the crisis mill we go through. And the very last market to experience stress or crisis, it will be the dollar. And that's something that's not appreciated in this system today. The other thing, we talk with people all the time, and it's interesting. I was chatting with a guy on Friday afternoon. He's managed some big money around the world, and we were talking about how this all works out and shakes out. And but the one point that really strikes me with a lot of conversations, first of all, like this conversation we're having today, I think it's being had by less than 2 or 3% of the market. That's it. No one else is having it. What strikes us the most, though, and it's very powerful, Dale, is that most people are not prepared to see a structural change to the monetary system. And that's what we think we're approaching right now. But because it hasn't happened, basically another Bretton Woods type event, that's what we're looking at. Okay. But because that hasn't happened in our lifetime, it hasn't happened for generations, people, they're just not prepared for it, how it looks, how it would feel. But that's where we're going. And the main reason we feel that way, I mean, if you go back to Bretton Woods, people talk about, the gold standard at the time, IMF, World Bank, and all that. But one of the key decisions from those meetings was the adoption of Keynesian economics. So everyone said, hey, this is what we're going to do. We believe we can control the business cycle or smooth it out, make it less volatile. And we'll do that by spending money, stimulating the economy, as well as by changing interest rates in the money supply. And, that works well when overnight rates are at, 4, 6, 8%. You have a lot of room to play with. Right. When we look around the world today, we're at 0. All of a sudden, they're introducing us to lower bound concepts and all that. But Keynesian economics and the ability to stimulate the economy, it's become increasingly ineffective. And for that reason, it means there's less dollars flowing around the world at the very point in time when everyone needs dollars to service debt, to keep the economies running and so forth. So, it's pretty precarious where we are right now.
Yeah, Keith, I've talked to other analysts that, talk about the same thing, dollar denominated debt and, what could create a surge in the dollar. What I found was in the piece that your associate wrote, is that there's a political angle to it, that it's being done to weaponize the dollar. And we know whenever we're weaponizing anything, who the target is in the last several years. So can you explain to me and to our listeners that, it was always my belief that the Chinese wanted a weaker yuan, so a stronger dollar would actually be achieving their purpose, so they could export more, even though they're supposedly becoming more of a consumer society. How does a strong dollar squeeze China?
Yeah, it's so with this piece that Keith Olin wrote, my colleague. Again, just we want to challenge people to think differently. So just to preface this, what you need to understand first is that everyone in the world who is following this closely, and that's at all the central banks and at different levels and governments that should be aware of this. We all know the world works incredibly better with a weak US dollar. It's just the way it is. It doesn't matter if sterling is weak or Canadian dollar or euro. If the US dollar is weak, it ensures that capital flows, trade flows, and so forth. Because we know that, and they all know that, and we look at the stresses around the world today that are really being caused by a lack of US dollars flowing, it's quite obvious that, hey, the decision should be, hey, let's weaken the dollar. That will fix a lot of things around here. But they can't do it. Yeah, they're trying, People would say, people who follow the gold market, they're holding gold for a number of reasons. It's a great store of value and, helps protect you during moments of crisis. But when, if I said to a gold investor, without them seeing the market, how central bank balance sheets would have expanded and deficits going and all this stuff, you'd think gold would be, $5,000-$10,000 right now, but it isn't. And if you accept where the market is right now with the dollar and say, wow, they cannot weaken the dollar, then you have to look at it and say, okay, well, what's going to happen? So the dollar is going to strengthen. And from our network, we know this is being discussed at some pretty high levels, and they've really come into accept the faith that, hey, we cannot weaken the dollar, it is going to rise. So then we come back to the whole China discussion and the piece that we wrote. So in one way, if you know it's going to happen, because of the way geopolitics works today, there could be a mindset to say, you know what, let's make it happen. And then you say, if it did happen, you know, who would not benefit from that? Who would be at disadvantage? And that's when we look at China. So the concept that in a normal world, if you have a weaker currency, you know, you can export more, you do better, and all that's absolutely true. And that's true in a normal business cycle. The problem with China is that because the currency is pegged, their capital account is also pegged. So, you know, for all of our economists out there or accountants, think of a country having a current account. That's where their trade will flow through. And think of their capital account. That's where you get capital and investment. So usually you'll have a surplus in one and a deficit in the other one. So for example, the US, you know, they have a current account deficit. That's because of net trade, and, you know, they're spending more than what they're producing. But yet the Americans have the largest capital account in the world. Foreign money will come in from China, Russia, London, Brazil, Australia. It will go into the US to invest because they like the rule of law. They like the investment opportunities that are available. They know there's liquidity. They can get the money out if they need to. Policies are pretty consistent and so forth. China does not have that. So if China were to want a weaker currency, you know, they could remove their peg and the currency would drop immediately. Then it's okay, why wouldn't they do that? You know, these are smart guys. Everyone is smart out here in the world. The reason they wouldn't do it is all of a sudden their capital account is no longer closed. And you're going to get a lot of very nervous investors in China, and their money will be flying out the window. So all of a sudden you have money flying out of the country. You know, it creates less jobs, less economic activity, more social unrest, and so forth. So it's a pretty tight game out there right now. So with the concept of that, you know, with the US dollar, you know, it could be revalued. Before it was a 0% chance. Right now we're telling people, hey, it's no longer a zero. So whether it's 1% or 10%, we don't know. But we do know it has been acknowledged at some pretty high levels in the US that, hey, you know, a strong dollar will have these effects on China, and it'll have effects everywhere else, but that's just, you know, that's collateral damage in financial war. So, you know, it could happen, and it would.
How do they make it happen? You said that their decision, knowing that it probably will happen, could shift to let's make it happen. How can they make it happen? How can the US government make that happen?
Yeah, well, the simplest way to do it is to simply, you know, you have
Raise
the president
rates?
and no, they
Or
wouldn't have to do that at
jawbone?
all.
Just jawbone?
Yeah, the old moral suasion, if you remember back from our school days, you know, that's what they would do. Even that in itself would work. But the bottom line, though, is that, again, the dollar will absolutely experience crisis. It's structured to do that. However, before we get there, all of the other currencies will experience a bigger crisis first. So again, when you get crisis in credit markets, you know, money flew into dollars and treasuries and so forth. If the next crisis occurs in emerging markets, which we feel it will, you know, then it go back into the dollar. And then after emerging markets, then you'll have the major currencies like Euro, CAD, Aussie, Sterling. And then after that, you have yen, and then, you know, you have the dollar standing. So the biggest trade of our lifetime coming up actually will be to short the dollar, but you cannot be early on it. If you're early, you're gonna lose your shirt most likely.
Do you have any idea as far as what kind of levels during a crisis, based on DXY or Euro or cable, how strong the dollar could get before the dollar peaks? Or that's a Nostradamus question?
No, I think you have to be reasonable here. I mean, if you're talking Euroland, Euro will break a buck, absolutely. I mean, people tend to forget. I remember traveling to Europe in, I'm thinking 01 maybe, and euro then was 88 cents, I believe, something like that.
Mm-hmm.
Yeah. I might have my year off a little bit, but you know, I was living in a US dollar world at the time, and you know, my travel friends, they were Canadian, so you know, I think they were paying $3 for a, you know, for a cappuccino, and I was paying about 85 cents. So it's a big difference. But you know, just back to price levels here, you know, the parity is absolutely in play. You know, with euro, and you look at, for example, the DXY. I mean, you know, 125 is not out of the question. But the challenge we have is that because most people don't believe in this story. Once it happens, it's too late. You know, so you've already given the nod once to say, hey, it happened back in March, which means nothing has been resolved. All that we've done around the world is increase the debt levels, and the only reason debt levels have increased is because rates are remained at 0%. So that's where we are with it. When these crises begin, you know, at the next level, you know, they you know what they say, you know, it happens fast, and so we could be, you know, 3 months to 18, 20 months away, you know, from this getting resolved. And,
well, you know, I could actually make some type of technical. I wanted to see how we could get there technically, Keith. And you know, if you take this high in the dollar up here at 103, and the low down here of 88, that's 15. So you tack on 15 from 103, almost gets you there, 118 on a breakout to new highs. So
those are pretty good lines. Yeah, those are pretty good lines.
Yeah, you know what? You know what people say? People ask me, Dale, how do you draw your lines? And my answer is with my imagination. So, okay. So if this scenario is going to happen while it's happening, are global equity markets deflating to the same degree, worse in emerging markets than in, say, for example, the U.S.? Bigger percentage declines and things like this. China, I mean, China really hasn't gone anywhere in a long time. Here's your monthly chart going back to 09. I mean, all these other bourses have taken out, well, the US has taken out the 08 high by a ton. And you look at the F.A.C.E, it's been sideways for 12 years. And not strong at all either in here with the recovery we've had in the U.S. before what happened recently.
I just think people need to be, I mean, I know we've had a pretty spectacular rally in equities over the last few weeks, you know, from the March low, but it's, you know, equities are fun to talk about. I tell everyone, hey, equities are one-dimensional. If you really want to understand what's happening, you know, go through the bond market. You know, we're at, again, record lows in the bond world. The yield curve is being flattened. You know, that sends a signal that, hey, money's either running for safety or it knows something other people don't. But we are clearly in this, what I would call a deflationary environment right now. And people need to pay attention to the bond market and the signals that it's sending along.
And are you shorting emerging market debt as well as equities?
Yes, we have positions on the debt side.
Okay. All right. Yep. So you're the opposite of Peter Bookvar. All right. So, you know, and you're both very good thinkers. I think it's interesting. That's what makes the market. So, Keith, I'm showing your website, and this is where you could get a hold of Keith and talk to him. You could also reach him at his Twitter account, and it's at IceCap Global. And I want to thank you for, you know, Monday mornings are tough for me at 4 in the morning. I want to thank you for getting up and hanging out with us and giving us, you know, this scenario that, you know, in this Cold War that we're in with China, a revaluing of the dollar could be also a pretty good political tool to continue to pressure them. Will it be like you think it's going to be? I'm going to leave you with this, because there are a lot of people. We've been in a Cold War with China for a long time. And you could be in a Cold War with countries for a long time, and then all it takes is one financial or economic, they start the war on that footing. And, World War II, the oil embargo was enough to motivate the Japanese to start a war with us. Is this going to be enough for China to possibly think that, we're being attacked, we have to protect ourselves, and this thing could turn into a hot war?
No, I think a financial war comes first.
Yeah, I know it comes first.
Yeah.
What comes second?
Absolutely. I
Just
don't know.
Mad Max land? Mad Max?
I'm worried about the first step, and
okay. All
money
right.
off it, and that's above my pay grade, maybe.
All right. Well, if we still have internet, we'll get back together and talk about it. Okay.
Sure thing. Thank you, Dale. I appreciate it.
All right, Keith. Thanks so much, everyone. That's Keith at IceCap Global, and a guy who has a finger on the pulse of some very major moves. Keith talks about the biggest trade of our lifetime being short the dollar, but from here to 120 is a pretty big trade in my view. So thanks again for your look and your view, Keith. Good hunting to you, and maybe we get back together in a few months and see how things are unfolding.
Yeah, absolutely. Thank you, everyone. Have a nice day.
All right, my trading warrior brother, Keith, and we'll see everyone for Turnaround Tuesday. Let me just look for this. Okay, hope everyone enjoyed the session. I'm going to wrap it here. Don't forget to count your blessings, not just your pips. See everyone tomorrow. Adios.